The second mortal sin is trading too big. Here's an equity curve of one of our systematic strategies. Our trading portfolio consists of a large number of these strategies traded together. The annualized return of this one was just over 20% in the backtest. Trading this and compounding your profits would have turned $10,000 into almost $60,000 in 8 years. 20% a year sounds pretty good, you say, but 200% sounds better. And you might assume that if we traded this 10 times the size, then we'd get 10 times the returns. Let's see if that's true. We'll assume that we have a very understanding broker who gives us unlimited margin, and we'll see how things would have played out at 10 times the size. Oof, that red line looks pretty rough. That equities curve tells the story pretty well, but let's have a look at the annualized summary statistics too. You can see we did a good job of increasing the volatility of the strategy, but a poor job of increasing our returns. We took 10 times the risk, as we estimate by the annualized standard deviation of returns, but we only realized 2 times the annualized returns. And it would have been a crazy ride. The 10% strategy significantly underperformed the smaller strategy at numerous times in this simulation, even assuming that the unrealistic assumptions that we've made here. So even ignoring the practical constraints, the math just doesn't check out on this. Mathematically, sizing too big hurts because volatility scales linearly with size, but expected returns do not. The volatility always hurts us. Practically, sizing too big hurts because we'll get margin called when we most need the margin. If you're oversized, it's likely your account's going to get liquidated. Behaviorally, sizing too big hurts you because it's difficult to make good decisions under stress. You're likely to panic, realize losses, and stop trading a good strategy if you trade it too big. We cover sizing and portfolio management in a lot of detail during the boot camps. It's a big subject, but you might be worried you're trading too big right now. So here's a rough rule of thumb which will serve us okay until we get to the more advanced stuff. Our rough rule of thumb is that the maximum annualized volatility that most people can stomach before they start freaking out and making poor decisions is about 20%. At this level, you can expect to lose over 20% of your account equity in a year, about 16% of the time. Note this is a maximum, not a suggestion. 10 to 12% is probably more appropriate for most beginner traders. As an example, hedge funds typically target 6 to 8% volatility because they start losing investors rapidly if they size it any larger. So how do you work out the annualized volatility of your portfolio? If you've been trading at least 6 months in a fairly consistent manner, then it's pretty simple. If not, then you'll need the returns from a backtest simulation. First, take the daily dollar returns from your trading accounts over the last 6 months, and if you're not trading, use the dollar P&L from a backtest. Then divide each daily return by the total size of your trading account. You can see that in column C in the picture, the Excel screenshot. This assumes that you've been sizing things relatively sensibly and your account balance hasn't moved a massive amount in the period. If you've been totally wild with it, then use the mean return of your trading capital over this period. Then, last point, calculate the standard deviation of daily returns and multiply by the square root of 252 to calculate an annualized standard deviation of returns. And you can see the formula to calculate that in Excel in the formula bar at the top. And when you do this, it's going to give you a naive forecast of the annualized volatility of your trading. Or in other words, it gives an estimate of how much your account balance is likely to fluctuate over time. If the number that you come out with is over 20%, then I suggest you cut your sizing. This is easy to calculate. It's easy to calculate how to cut your sizing, because as we've seen, volatility scales linearly with size. So let's quickly look at that. We can calculate the factor by which you need to adjust your size by the ratio of the volatility you want to the forecast volatility you're likely to get at your current size. So let's say that as you're currently sized and positioned, you've got a forecast annualized volatility of 30%. But that's a bit wild. You want to aim for a volatility of 15%. Then you simply need to reduce your sizing by 50%. Let's do another example. This time your forecast, what you're currently trading at current size, is 5%, and you're aiming for a target of 12% annualized volatility, which is a 140% increase. Then you simply need to multiply your current sizing by 140%. So I'm going to just address an objection that I'm sure some of you will have now. You might think that you can handle more than 20% annualized volatility. But unless you've been trading for a decade or two, you probably can't. And remember from earlier, sizing bigger only guarantees higher volatility, not higher returns. Even ignoring the behavioral effects, the maths just isn't on your side with this one. So this rule of 20% max annualized vol is going to keep you on the straight and narrow and keep you in the game, at least until we can have a more detailed discussion about it. The most important thing is always to live to fight another day. So keep your trading small.